Hi, folks. I have again here Martin Tixier, and my name is Zoltan, and we discuss again impacts on financial market. Following the research Citrini had on software stock, we're discussing the consequences for AI for soft and hardware. We come back also on the palladium trade and discuss some disruption in the EV space in Europe. If you stay on until the end, Martin will talk about the credit market and how this can be compared to the financial crisis. Hi, Martin.
Hello.
It's great
Hello again.
to have you here. We will do that on a regular basis, I guess, from here now, and we got also nice feedback. We have seen Citrini Research, a shop
Yes.
I never heard before. How you look at that research, which caused some sell-off in, I think, in the software shares and also in other stocks this week?
Yeah, absolutely. Citrini Research, the reason why it's the number one, or probably in the top 5 followed Substack in finance in recent years. So it has a huge follow-up. It's been a very successful Substack in the finance space, and they released that piece focusing on projections on June 2028 about how disruptive for the job market potentially AI could be, saying that it would be so disruptive and destructive in many instances, in many various parts of the employment market. So that has led to, of course, to have a significant impact, and has led to some serious sell-off in the software space. IBM was not spared. It was also linked to the article of Citrini Research, but you also had releases, some quick tweets released by Anthropic, who's the company behind the Claude AI AI tool, which basically said that they had taken some huge steps in the cybersecurity space. Sorry, they also had taken big steps into rewriting old codes like COBOL, which could be potentially very highly disruptive to IBM. But I think markets have mostly overreacted, trading on the news. It was a question of fire first, think after situation. So a lot of sectors in the software space were totally impacted by this Citrini Research, on top of the Anthropic tweets we've seen.
Absolutely.
Yeah.
And that's already on a trend which has been ongoing for months, actually, that the software, if you look at the ETF on US software firms, it's pretty down, but it has caused like another acceleration. But so your interpretation that that's more a bit this sell-off is a bit overcooked in your
I
eyes? Or?
think it was due to happen because the market, as always, was trading above their head. It was like the AI has been like a followed up fear of missing out trade. Everyone has been piling up on this trade. There's massive, no question, investments in the space in terms of the hyperscaler in the capex space. Huge amount of debt has been issued. So a lot of people said, look at the CDS market, is trading very actively in that space. But in fact, the reason why CDS has become more active is it's because as well as that the issuance levels have been very significant. And as such, you see like a new active name in the space of CDS in the likes of Meta and other tech names. But I think it's more due to hedging purposes than speculative on potential default down the line. And I think that given the huge amount of bonds, investment grade, which has been issued, I think now AI represents around 15% of the whole investment grade universe because of the size of the issues coming to the market. Yes, CDS activity has been picking up, but I think it's mostly due to large players covering their exposure, like a loan book would cover their banking loans by buying CDS protection, and they would carry the protection until the maturity of the loan. So they would use the CDS as a hedging tool rather than a speculative tool. So hence, I think the pickup in activity. But returning to the Citrini research piece, I think they're trading way ahead. Hence the title of my last post, which was Field of Dreams, in reference to the famous movie about baseball and Kevin Costner, who's building a baseball field in his cornfield to ensure that past ghosts of baseball would come and play in field. And the quote is like, if you build it, they will come. And as such, the Citrini research, I think, is as well is a kind of projection anticipation work, like science fiction, because they're projecting the U.S. economy until June 2028. But I think that it's blatantly missing the whole point. The whole point, as we mentioned, is mostly due to the lack of infrastructure. I think the whole story is around the energy needed for data centers, the modernization of the electric grid, the supply chain management, the raw material that is needed to effectively build the field, to have the ability to play the new baseball, which is AI. And as
Yeah.
such,
So to summarize, it's more about infrastructure and then commodity demand, which then
exactly, yeah,
translates to
yeah,
energy demand, or
I think so.
that's your point. Yeah.
Yeah, and the
Yeah.
point I made in my most recent post is like in strategy, like real generals, they don't focus on tactics. Like Citrini Research has been focusing on. I think you need to focus more on the logistics part, which is the real strategy. And as such, that's why I believe China is ahead of the game, because they have totally controlled and masterized supply chain management. And in terms of having the infrastructure put down, uh, the US, well, the United States is lagging behind China when it comes to the modernization of their electric grid, when it comes to the number of nuclear reactor they have. I think in the last 50 or 40 years, the first time the United States is building a new nuclear reactor. China is building 250. India as well is building some new nuclear reactors. So I think the real name of the game is making sure you have the infrastructure. Otherwise, you don't have data centers. Otherwise, you don't have the energy.
Yeah. So now, as the market is focusing, as you're painting it on the wrong topics, what are the opportunities? Should one invest in coal? should you
Well,
look more and
I think coal is still a very good play for all the reasons we mentioned.
mhm.
Particularly in the renewable space, you still need 15 tons of coals to produce solar panel, but the cost is going down in terms of production, but you still need some input. You also need silver paste for solar panels, so the silver story in terms of industrial use
It is
has
still
not gone away.
intact.
Yeah,
Yeah,
it
it's
is
still
still intact.
intact. Yeah.
But as well, I think that uh, if you take the sector of power suppliers and grid enablers, they're going to rally further because, as I said, it's about field of dreams. In order to have your dream of AI, you need the field. To have the field, you need the electric grid. To have the electric grid, you need copper, you need silver, you need the raw material, you need
Mhm.
supply chain management, and I think that's the real picture. The real picture is all about that. Now, everyone as well has been focusing on the earnings, the results of NVIDIA. Uh, I'm not really surprised by that because in any kind of, I would say, AI is the new gold rush. Uh, the companies that make most money out of a gold rush or AI rush are the ones supplying the shovels for the gold diggers. And in the context of NVIDIA is the guy supplying the chips for AI.
Yeah,
So
and we see on the real estate side a lot of story about data centers and
absolutely.
development money into data center developments. But just going back to another dream, more a European dream is about the EVs, the electric vehicles. So we
Yeah,
had also some stories on that this week. So
absolutely. Like we didn't have like totally finished our last conversations about Europe lagging in the EV space and like companies rethinking their AV take up, such as Porsche we mentioned in our last conversation, as well as the BYD print in Latin countries such as Brazil. And we said in our previous conversation that Europe was not at the same level as China when it comes to electrification in terms of electric grid, in terms of power supplies to power up the electric cars. And as such, that's why palladium was such, I think, uh, a good metal pickup because of the need of palladium for hybrids. And I mentioned that whenever I take a Uber, the guy is driving a Toyota hybrid. And we had the shocking results of Stellantis Group coming up with a loss of 23 billion euros because this group bet the farm on EVs. And I think that the European market is definitely not at the same stage as the Chinese market, for example. The take up in EVs in Europe will be much slower in core Europe. I'm not talking about Norway. I'm not talking about Sweden, but the German market is still dominating in the premium range by the likes of Mercedes, as you know. But when you talk about the EV take up, I think it will probably go towards EVs, but at a slower take up. So that's why the transition will go through hybrid. Hence my bullishness on palladium.
and since we spoke last week, I have seen the palladium trade also has picked up. But also, if you look compared to silver and platinum, as you painted out, it is still lagging. If you look, we're still away from the all-time highs in that
Absolutely.
metal. So it's interesting diversification play also for probably institutional investors who want to diversify a bit their metal holdings.
Yeah, and
So
when you look at the 5 years performance of palladium, it's been definitely lagging by a lot, both gold and silver, but as well it has been lagging copper. And as such, we mentioned in last conversation a potential substitution effect between the cost of platinum versus palladium for car companies. So palladium is the cheaper option as such. So I think
no,
that palladium
absolutely,
will
yeah,
will
yeah.
will continue to rise and maybe close the gap because it has been lagging other metals as such.
Absolutely, and then we continue also to follow that also in future calls. So whether we that will come out as you've been expecting. But one key topic I want to discuss with you is the credit vibes from the GFC period. They are
Yes,
coming back.
they are.
So
They are. Like we mentioned in the last conversation, First Brand, which is a subprime car lender, we had like a shocking binary outcome where the values of even senior loan we were supposed to be collateralized like totally collapsed on par to zero. Basically because the same collateral was pledged several times, and we have the same story apparently coming up with a financial company in the UK called MFS. And what is quite surprising is that you have like very sophisticated credit players, which have been taken for a ride. And this is the kind of credit stories we generally tend to see when we're coming in a credit cycle which is maturing, which we mentioned last time. So we're seeing a
mhm.
pickup in M&A. We've seen the largest LBO trade last quarter with the private takeover of Electronic Arts for $55 billion. So that was probably the biggest LBO trade ever done company-wise in recent years. And we had the
I
same thing,
remember like
remember, in
Kushner was
2007.
also part of the takeover.
Yes,
So me as a gamer, certainly quite following also EA
absolutely.
in the past, but but that has been, I didn't know that was also financed certainly by a big LBO
Yeah, it was a
transaction.
huge
Yeah.
LBO transaction.
Yeah.
So you have like a big M&A pickup, you have LBO activity picking up. At the same time, you have these stories about like a big losses in some corners of private credit. Doesn't mean that the whole sector of private credit is rotten to the core. I think a very good indicator of how late the credit cycle is not only M&A activity, LBO, this kind of of credit stories unfolding, uh, but also a very significant rise in dispersions, both in the equity space as well as in credit. You see, rising dispersion is a sign that active managers are becoming popular again because you need to brush up your credit skills and you need to be more discerning uh, from one issuer to another issuer. And this is typical of a late stage of the credit cycle. I would add to this some Ponzi scheme unfolding. Most recent one in the crypto space, you had a company called CEO of a guy who was the CEO of Goliath Ventures. He just got arrested for apparently scamming people from raising $328 million from investors and promising unsustainable monthly returns like Madoff kind of style, like promising like 3 to 8% on a monthly basis. So that's a typical Madoff like end of credit cycle story. Remember, Madoff unfolded right at the end of the credit cycle before we had the great financial crisis, if my memory is correct.
I remember I was then in New York with the stabilization fund managing the bad bank, actually the Swiss bad bank, and I know I remember the joke that you could get the tickets from Bernie for the, what was it, the New York Yankees lounge, which were the best tickets then. So so certainly just to remind some people on the past that we've been here before. Also, we
Absolutely.
both have been
Yes.
here before on the credit side, certainly. And
So this is why I have these 2007 vibes, because I'm seeing these stories emerging again, like some scams unfolding, some credit difficulties and liquidation in some of the space, uh, overvaluation in some other space of the credit world as well as equity world. So yes, the market is starting to become more discerning, hence the rise in dispersions. I think that's the big story out there on both the equity space and the credit space. So all point out to the signs of a maturing credit cycle, I would say.
yeah, and do you see any like opportunities or more on the general side that also like more retail investors could take, or do you see it more that one needs to do really proper due diligence? It's more something for institutional investors now. So that's more or
I,
less
I,
my
I I think
question here.
it needs more active management for sure. You need to pick up very good like credit managers who have like very good skills in selecting the issuers according to the credit profile, and the need for active management. And I think that gradually, if we see more deterioration in the macro picture in terms of employment in the US, more stories coming out uh, from uh, from uh, from credit stories unfolding in not in a nice way, I would say. Then it means that you need to start to become a little bit more, I think, defensive. If we enter a recession, then obviously you need to become more defensive and rotate probably from high yield, high beta towards a safer space such as like investment grade as such. So
Yeah.
starting like protecting protecting yourself from a potential start of a default cycle. So as such, reducing the exposure to like triple Cs, for example, if I take the high yield sector in the US, which is highly exposed to energy or to IT or healthcare, and even software in some instances, and play the rotation towards a more, I would say, defensive position as such.
Good. As the tide goes out, you know who is swimming naked usually.
Absolutely, but yes,
Yeah.
as you've been there as well in 2007, we have all these little sign that shows, yes, gradually it's not going to be brutal, but we're starting to see little hints that things are a little bit changing in terms of valuation in the credit space for sure. So you have, it doesn't mean it's going to happen tomorrow. I think it's maybe 6 months to 1 year. It's very difficult to time these kind of events uh, because you could have some acceleration because of some geopolitical issues coming up, like inflation could come more rapidly because of the geopolitical situation for sure. That would accelerate the repricing and the rotation as such. So it's difficult to ascertain when the turn is going to happen, but you're already seeing signs of like rising dispersions, M&A activity, LBO that points towards a maturing credit cycle, I think.
Absolutely. And I think that's why it's important that we come back again, Martin. Thank you very much for your time today. And for those who like to follow our content, don't forget to subscribe to our channels. There's a channel from Martin and mine. And also there's Substack. You can check out more content, and then stay tuned. We will come back.
Absolutely. Thank you very much, and have a good afternoon and good weekend.